Fantastic. All right, Shelley, take over.
Excellent. So, okay, 30 minutes. So that is a tough act to follow, I would first say, especially with credit. But I have an able panel here. So my name is Shelley O'Donovan. I have a small training business where I go into companies and help them with messaging and communications and influence management. I teach at Wharton as well, and do some work now for Marty. And I would give one more final plug to the podcast. So I hope you're all listening. With that, though, I'd like to turn the agenda over to credit. And so I'd like my esteemed panelists here to introduce themselves, and then we'll get right into the discussion. Yeah, press it again for a second. No.
There. Thank you, Shelley, and thank you, Marty, for having me. My name is Greg Shore. My firm, Rigger Shore, is a boutique capital advisory and financial consulting firm, specializing in credit markets specifically, mostly on the early stage businesses, working with an event-driven capital solution product and mostly M&A, turnaround, restructuring, as well as project finance. So a pretty diversified credit and investment profile.
Excellent. Joel?
Hi, I'm Joel Gostroke. I cut my teeth as a restructuring guy and ran a litigation fund for some time for working for a family office, specializing in credit investments, opportunistic credit, and workouts, restructuring, crisis management, when things have gone horribly wrong and stuff's caught fire and, half the contents of the till is missing, that kind of stuff.
So maybe you can both set the stage a little bit for what you see happening right now, what the outlook is in credit now, and then also moving forward into the next year, if you have any insights there.
So credit's always an interesting thing with credit. So I was thinking about this and how to think about it, because it is called credit strategies after all. Because if you think of credit as a strategy, you're putting, I suppose the question is, where are you putting your money? If you're putting your money into a credit fund, you're buying both old and new credit. And then you kind of need to know where the credit market is. If you're buying new credit, so you're lending either directly to a borrower or you're looking to, you're entering into a new fund, you're in a slightly different position. But in terms of the existing lenders, the analogy I was thinking of is that scene in Jurassic Park where the rain's coming and they're sitting in the broken down car and they hear that. And that's where we are in the credit markets at the moment. So how worried should we be? How worried should we be? As with any form of impending dinosaur attack, it kind of depends on where you are. But I'll leave that there and I'll let Gregory.
I'll agree largely with what you said in that we are seeing some serious tremors in a number of different asset classes, and it's certainly cause for concern. But I think that I tend to be a bit more optimistic on several industries, and it's all segmented in the way that we can look at these micro markets and find opportunities that.
I think it's a great time to get into credit because credit's backwards. The fact that I don't know, one of these big credits, someone like Blackstone or Blue Owl will wake up one morning and find that it's collapsed is its own separate problem. But as a credit investor, the opportunities at the moment are still large. Rates are still high in terms of, well, not high, but rates are still high enough that if you're lending into markets, you can actually get decent rates of return. We're now seeing companies go into Chapter 11, which means that if you're interested in opportunistic credit, well, if you're interested in restructuring credit, there is now a reason to invest in a restructuring fund. We can now do some restructuring work, which is actually quite exciting. There's great opportunities in the credit market when it comes to restructuring, when it comes to secondary debt. In real estate, it's the same thing. Again, if I'm a bank, if I'm a lender, I'm holding existing mezz debt on a commercial property that's now pennies on the dollar, I'm not very happy. But if I'm coming into a credit market, these are interesting opportunities to be able to go talk to the banks and pick up some of this debt, and really do quite well. The thing with debt strategies as opposed to equity strategies is you sort of end up locked. And that tends to be as a lender, you're not trading out as rapidly as you think you are. So it's that historic credit that tends to be the problem. New credit is new credit. And absent being not doing your due diligence properly, you shouldn't be seeing problems with new credit, right? Like, I think, Gregory, you'd agree, right? You shouldn't.
Yes. Yeah.
You shouldn't see new credit. Like, new credit should be a problem like a year. You sell credit year 1, year 2, year 3. That's not when your problems are, right? It's further down the line. So that's why, as I say, in spite of the macro environment, which I find extremely concerning because it has knock-on effects for all sorts of things, from the point of view of a family office, high net worth, ultra high net worth, I'd say in some ways it's significantly, if I'm looking at areas to invest in as general universes of investment, I'm actually much more relaxed about credit than I would be about equity at this point.
Any additional comments on that, or?
No, I think that's a very fair point.
Okay. So if I'm a family office, so how should I interpret this pattern of institutional investors exiting just as retail flows enter the private market? Any thoughts around that?
Yeah, I think it signals kind of a late stage development inside of the market, just in terms of timing. It's almost that institutionals have really absorbed I think, returns that they can recognize in a risk adverse manner, and then you see a desire for higher yield, and that's kind of causing this inflow of retail investors and just their desire for yield.
Yeah, I mean, I think it's the flow to retail is deeply concerning because it's not retail going into new credit issuance; it's going into this historic stuff, and no one really knows what's in it. I mean, just by way of a recent example, Blackstone had to write down, this was mentioned on a different panel yesterday, Blackstone had to write down its debt in, which one was it? Renov, that was one of the recent Chapter 11s, had to write down $100 million of debt down to zero in their 10Q, which had been released less than a month earlier, was marked at par. You're marking down from, it was 150, down to par. So par to zero, less than a month. This is Blackstone. These are the guys. They've got that lovely office up there. Should know what they're doing. Shouldn't be writing down debt. You go, well, surely there's like 20 cents left in this stuff. Nope, zero. So that's the problem for those flows. I wouldn't be chasing those retail flows. I think that would be my answer. Just don't.
I agree, and that's definitely the vintage piece to where those retail investors are entering is particularly risky.
Yeah. So which layered or structured debt instruments today most closely resemble the pre-2008 environment? Any thoughts on that?
Do you want to take this?
I mean, I think that whether it's fund to fund or some NAV products, I think can be of particular concern, and just the overall increase to complexity that we're seeing a return to is really, that's where we're going to see, I think, bigger issues, and again, it's a precursor, just like we saw, with the GFC.
Yeah, I mean, I'm a very simple man when it comes to these things. I like to see debt issued against a borrower for an amount for a term, and the more complicated it gets, it just increases. It's all very well, but it doesn't decrease the risk
Okay.
in the way that you'd like it to. And these products generally don't.
Yeah. So can you speak a little bit to that risk and just like how the current private credit documentation standards um, are they adequate for
Well,
investors, or
Is
can you?
so
What's the
Gregory? Is there a
downside risk?
is there a private credit documentation standard?
No, I mean, that's kind of the purpose of private
I
credit.
was going to say they craft these niche documents which are all amazing,
Yeah.
and there's lots of competition. So quite what the terms are to some of this credit is highly variable. And so I mean, at least they're drafting documents, which is more than some of the things I saw when I was dealing with the cleanup from 2008. But some of this documentation is highly varied. It's extremely complex. These aren't simple loan documents. You'd want some serious lawyers looking at them. They're not simple docs at all. In terms of the products that they then create, the issue you have is essentially what they're doing is what the thing they've enjoyed doing is basically taking the tranches of security, splitting them out, and basically saying, oh, well, how to put it? They're creating they're layering the repayment of the security, which allows them to go to the ratings agency and get a higher grade, higher score for the debt that they issue, which is better than the underlying debt that they've bought. So from a backwards perspective, they're able to earn 12, 13% because they then layer it out. They have these tranches which are now only 5, 6% because it's AA, but actually the underlying security was only a piece of junk, to be honest, or possibly lower grade. We'll get with lower grade, not necessarily junk, but that's sort of these layered products. Again, there is no consistency of paperwork on these docs, on these underlying loans within these docs. Yeah.
It is concerning, just the lack of consistency among the docs, and then trying to find a uniform rating on them. In a lot of cases, we are looking at, whether they're Cov light or there's so many adjustments to EBITDA that are made that it's difficult to gain, a true quantitative measure of the risk factor. And then when you layer them together, it's just the complexity is an issue.
So if you think a little bit about the commercial real estate market, so is that now the largest single point of credit risk, and how are lenders marking down those assets?
I mean, they mark it down if they have to, I'd say. You agree? I mean, you don't mark down unless you because it's not, so none of this, so we're talking about private credit and none of it's liquid. And so it's a bit like venture. There's no real need to mark it down until you have to. Mm. So unless there's an event, you don't really, this stuff is never, you really try not to mark it down. The issue you've had is commercial real estate's been so crap for so long and the valuations have been so low for so long, they can't ignore it anymore. And it just pushes out, and there's too many comps now coming through to be able to ignore it. So what you're seeing is the banks and the private lenders. I mean, commercial real estate's more of a mix between banking sector and private lending. There's still a lot of banks in commercial real estate. They are starting to come out, and I think this was discussed on the real estate panel yesterday as well. There are opportunities to buy out some of that credit. At that point, it's distressed special situation stuff, which is, as I say, nothing wrong with special situations credit opportunities. You just have to interrogate them one at a time. And there's some very nice deals out there, I'd say, in the commercial real estate market as a distressed mortgage buyer. And I think now's, if that's an area that you're looking to expand your portfolio in, coming in as a distressed mortgage buyer is probably the best. It's probably the sort of one of the easiest ways to really do it from that sort of side of things.
I think that I read somewhere that valuations on office are probably one of the biggest systemic risks in terms of I think a decrease in value was 30 to 40% since the pandemic, and really we're seeing the 2019 to 21 vintage coming to maturity between. I mean, I think there's 1.5 trillion coming to maturity before 2028. So that's something where you do look at it and say, one bank's issue is another, private credit or investors' opportunity to find deals out there.
Yeah, and I mean the other thing to commercial real estate point, the data center, drive that we're seeing, obviously, AI take a shot. That side of things, there's been some very big deals done in terms of the mortgage piece of that. Big deal recently between Blue Owl and Meta. The quality of that security it's very hard to know whether those valuations are sustainable for the length of run of a mortgage. When you think about what a data center is, a big empty building. If you think about it from like a real estate, let's just be real estate guys for a minute, right? It's a big empty building I fill with expensive equipment. That expensive equipment rapidly becomes inexpensive equipment. What are my obligations for power? What are my obligations for, what are my obligations for power? What are my obligations for maintenance of equipment? Where is my security? What's my security valuation? And it's just like, well, at the end of the day, it's a big empty box in Kansas. I'm like, who cares? And this is about from a debt, like that's stressful. If you're thinking about that from a debt perspective, and I'm looking at shares of Blue Owl and go, well, shall I buy Blue Owl or shall I buy their funds or shall I? And this is not to single out Blue Owl. There are other players in this space, but these are not, this is just fundamentals in credit are absolutely crucial.
Yeah, I think I've got a question here.
I want to address your comment in relation to data centers, et cetera, because your point is well taken. If I were going to put money into a data center, I'd have to evaluate how long that data center is going to be operational at the current standard with the current technology in it, because your point is well taken. What the hell do I do with the building if I own it and it's obsolete within 5 years? So my analysis of them would be, how do I get my money back with a return within a certain span of time before this technology becomes useless? So if you can address that.
Yeah, so you've got a sort of double problem. There's two sides to it, which is the classic sort of debt, how you sort of think about debt, yield and security. What is the quality of my underlying security that I hold? Okay, cool. The NVIDIA chips inside this building are great on year 1, on year 2, they're not so great, and by year 5, they're worthless. Same again, if I've got power, if I've got an obligation to provide power at a certain rate, what are those costs going to look like? Thirdly, then does the yield match that? And that's the most important thing. So this is where this layering starts to come in. This is where, are we guaranteeing certain things, right? What is the nature of the deal? So if we think about this Blue Owl, Facebook, Meta deal, what are the guarantees being given? Because Facebook are the tenant, well, Facebook are the tenant, so that's great security. But if Facebook can pull out pretty much at will, I don't care that it's Facebook. We need something different. Bye-bye, right? So, but you end up with documents that people go, well, Facebook's got a B- credit rating, so we can apply a B- credit rating to this piece of security, and therefore the yield then the yield comes down. And the short answer is, I don't know. I'm not in these meetings. I do know that these companies have a lot of money set aside that they need to lend. They're under obligations to get their money out, and some of them are having difficulty getting that money out, and it's starting to go to places that people don't, that you wouldn't expect, that they're not necessarily going well.
Joel, are you saying there's overcapacity in the market?
At the top end, massive overcapacity. There's a lot of money there. They need to do big deals.
And you're getting quality degradation as a result.
I was asked about getting mezz security on a yacht 2 weeks ago.
What's the LTV?
I mean, the main question is, when does the loan go underwater?
The main question is, where is the yacht domiciled?
Well, I mean, it's in the Med, but it's the point is not the point is not the details of marine mortgages. The point is, this is not a discussion anyone should be having. This is a ridiculous discussion that I'm finding it, that this was a discussion that came up. How are we having this discussion as a credit thing, right? It should be like, go away, you can get your marine mortgage. This is what a marine mortgage looks like. And the last time I saw someone overdo a marine mortgage, it was as part of a massive multi-million fraud, which brought down 2 Irish banks and involved the Prince of Monaco. It was the last time I saw marine mortgages do stupid things. So I don't like it when I see things like this. It suggests there's a lot of credit going to places that they shouldn't be going. And I don't know where it is. No one does.
So family offices are big consumers of credit. They historically have liked bridge lending in the USA.
It's great. It's great.
I think a focus on asset-based
Lending.
asset-based or other niche downs. I think that's really where, you could still find success, find opportunities, outside of the big, I know AI, we love to say that it's a big boom, and it is. There's a lot of dollars flowing there, for sake of not being wrong with potential AI investments. But I think that sticking to fundamentals when you're in uncertainty, I think that's where, sticking to those niche products, again, asset-based lending, where you have
Factoring.
factoring, you have true
There's good
assets
stuff
you're getting
out there.
repayment on.
There's good stuff out there.
Yeah.
It's not disappeared. There's good stuff out there. There's asset-based lending. There's receipt-based lending. There's some nice factoring. There's some nice commercial opportunities.
Litigation finance.
I mean, litigation finance is distressed debt on steroids. That's all litigation finance is. It's fun. It will probably make a comeback as we have more litigation. There's a lot of people in the space. It's certainly growing. I like it, but I used to do it. So it is technically credit. What I wouldn't do is lend into a litigation finance house. That would scare the bejesus out of me, because you're lending into distressed debt. You're lending into distressed debt recovery.
One of our speakers said there's no such thing as distressed debt. There's only poorly underwritten debt.
Fine. So it's fine. Okay. You could argue that. I mean, I'd say the difference is, am I buying it at a significant discount to par? And do I think I can recover above that, at that par, or much further away from that discount? And that's what kind of defines your distressed debt space. The fundamental difference from credit is, the whole point of credit is, I lend you money, I get my X% a year, and I get my capital back, right? That's the whole point of credit. Distressed debt, the fundamental difference between that and distressed debt is I buy a loan, which was the $100 loan for $20. I don't really care about the interest rate, but what I actually want to do is get $40 back from the borrower. And then I'm very happy because I just doubled my money. That's the fundamental difference. So if I'm thinking about yield, I'm in credit. If I'm thinking about gross recovery, I'm in distress as a market.
So last question here, I think. I'm curious how the federal shutdown has really changed the risk profile of lenders. financing government receivables. And, as that was previously considered one of the safest bets. So Gregory, maybe we'll start with you.
Yeah, so I'm working a good bit inside of the I'd say defense infrastructure space, and working with several clients in the GovCon space. And I haven't felt a real pullback in terms of willingness among private credit investors or sponsors from that side to make those investments, to move forward and continue to see people investing there, because when it comes to it, especially in the defense con space, like you're still going to have that faith that something is going to get passed eventually, and the government's going to be able to support those industries and make those payments.
Yeah, I mean, we seem at this point to be get dealt with. But I mean, the Senate passed closure, so that's kind of like the key bit. So, but we'll be back at this in a few months. It did get to the point. It was having ramifications. So I've been talking to some guys who are actually running a credit fund who are doing this and helping them out with some of their stuff. So that, and it was like, this has been like trouble free for forever, and now it's been, now it's suddenly stressing us out. But I mean, it's had wider ramifications. I was talking to, in healthcare, healthcare people, just haven't heard that obviously from the FDA on stuff that they need. It was flowing through, as you say, the defense sector, it starts flowing through, and people are pretty understanding. You can get solutions to these things, but it was not good.
Well, I just want to thank you both for this excellent panel on credit. And thank you.
Fantastic. Great job, guys. Shelley's going to stick around. I have a couple of different comments. So I know we had an AI discussion yesterday. OpenAI has been subpoenaed, and the judge has agreed to provide 20 million chats between OpenAI and users to the New York Times, which is suing it. And they're going to do an analysis of how many times OpenAI does wrong attribution to the New York Times. So it's going to be a pretty big lawsuit. It amazes me how ChatGPT is wrong so much. It's amazing. And then they always upgrade how much you have to pay for it, and then they degrade the prior version you were paying for it. It's terrible. Anyway, we're going to talk about private equity. I've got Sammy Dweck here. Guy Clementi had a medical problem, so he will not be here. Marco Soriano is supposed to dial in. Sammy's here, and I've got Igor. Take a seat. Sokolowski from Barclay Street Advisors. Shelley's going to be moderating them for about 40 minutes, and we'll go from there. So we're talking about private equity, and maybe we can get some intros. So.
Yeah, excellent. So thank you. Again, I'm Shelley O'Donovan. I have a company in the Authentic Influence Group, but I'm going to plug the Resilient Alpha podcast again. But with that, I want to turn it over to my panelists to introduce themselves. So Sammy, we'll start with you, and then I think we'll go to Marco, and then we'll come back here in the room for introductions.
Good afternoon, everyone. Very disconcerting seeing my face on the other side of the screen from here. Very weird. It's like I'm talking to myself. It reminds me of Max Headroom. By all means, guys, look at my profile. I don't want to take too much time on intros. Look at my profile on LinkedIn. I do a lot of work with family offices, but in particular, I sit with two where I'm on their investment committee overseeing all their liquid investments, where, amongst other things, we look at private equity.
Excellent. So is Marco on the line? Not yet. Okay. So we'll come to you then in the room.
Hi, good afternoon, everyone. Igor Sokolowski. Pleasure to be here.
Take the mic. Yeah.
Hi, good afternoon, everybody. Igor Sokolowski here. I'm happy to be here. I'm a lifelong investment banker in healthcare, mostly a little bit of media. I've worked with several top firms and pursue an independent route now, and look forward to chatting with you today.
Excellent. So for first question here, as we move into 2025, how has your investment thesis evolved? You know, given the rising stress signals in both the private and credit and the private equity markets. So we'll start here in the room and then we'll head over to Sandy.
I think this year has certainly been challenging, and it's probably fourth year now that M&A market has been under strain. While we still see some amazing activity in some sectors in tech and maybe AI related, overall activity in sort of traditional sectors has been declining, and significant volatility, particularly in the middle of the year, some of it tied to some tariff announcements, has definitely threw ice on people's willingness to write checks and close deals. I think that generally people who get deals done, you need to see flexibility on both sides and a lot of patience, and generally you need a lot of motivation on both sides, and for sellers, cleaner, higher quality assets, obviously easier to transact. Buyers look for, I feel like, excuses not to do deals. In private equity specifically, what I've seen is that when it's not a greenfield deal, but an add-on to an existing portfolio of companies, not every portfolio company is doing well enough to be doing acquisitions. And if they're not doing so well, then the bar for finding the right target is much higher. So you need to be more nimble, more selective.
Yeah, excellent. Sammy, any thoughts?
Yeah, well, if we're talking in the context of private equity, I think my view is somewhat divergent. So yes, the tariffs were noise, and they were, because we saw the sell-off and then the bounce. So if you're in liquid markets, great buying opportunities. But in private equity, where you're looking, 4-7 years out, you're not looking at the short-term vol. It's less relevant. You're looking at the themes and opportunities, and that's more focused on, who are the players I think I could get the most juice out of, where I feel comfortable locking up my money. Yeah, I agree with the comment made about M&A, and that did hit. I've seen that more hitting some of the hedge fund guys that were reliant on M&A. But if we're talking pure private equity, again, it's more about themes and looking for something that's different. So diversify for the portfolio. Diversify not only in terms of like the family, what they have as a core investment. So for the main family I look after, it's real estate, which is they do direct. It's 60% of the portfolio. So you want everything but real estate. And that takes things out of play. So part of credit goes away. So then it's, okay, where can I put my money? So again, 2025, I don't really care about when I'm investing in private equity. I'm looking at what themes do I think are going to be playing through to 2032, 2035.
Excellent. So do you see the increasing involvement of retail investors in private credit as a late cycle indicator, and how should sophisticated investors interpret that shift?
Is that to me?
Yeah, we'll go back to you.
So retail investors in private equity really doesn't impact that much, because if they're going to go to anything, it's more of a liquids evergreen type of structure. So evergreen has been, I think, born to feed the appetite of retail investors. And then you've seen people like KKR and Apollo list the GPs to try and get people in, but that's not really private equity. You're getting some access to it, but you're not going to get anything close to the return. So I don't think retail worries me so much. Private credit, with all due respect, I think too much has been put on private credit in secondaries, to be honest. And that's where I'm a lot more cautious at looking at opportunities. You've got to be a lot more selective if you're going to go in and go with eyes wide open, especially if you're locking up capital for multiple years. It's not like you can just say, "Oh, I no longer like private credit, I'm out." You're in, right? It's like a marriage contract with no annulment opportunities.
Interesting. Any thoughts?
Not on this
No, no. Okay. So you mentioned private credit and the secondaries there. So with the continuation of funds, GP-led secondaries and NAV loans becoming more common, do you see those tools as healthy innovation, or do you think that's liquidity stress? Any thoughts? Do you want to start? Use the mic.
Well, generally speaking, and maybe I'll just answer it in a more broad way. What we've seen is there have been very few exits from private equity. The number of deals that private equity has done have declined, both acquisitions and add-ons, but the real decline has been in exits. And so there's definitely been a rise in continuation vehicles. Many financial advisors even modified their engagement letters and said that if at the end of the process you pursue a continuation vehicle, it qualifies as a transaction. Maybe it was a reduced fee, but it's a transaction. So it's definitely been a rise. There's been some commentary here yesterday on that topic that LPs aren't happy about it, and that's frankly an opportunity for family offices to step in and sort of along the way provide secondary liquidity to some of those participants.
I have a question.
Yeah.
So, I mean, I guess one of the things that people talk about, like inflation gets hidden, like when you go to a grocery store and they call something shrinkflation, where you got a box at the same size, but there's less of the stuff in the box, right? So a lot of people go to private equity because there used to be a promise that in 5 to 10 years you'd have liquidity. But now everybody's talking about a 15-year scenario for both venture capital and for private equity, which seems to be unrealistic for many people who want to be buyers in the market. I think somebody said yesterday they'll be dead by the time their portfolio has all the exits, right? And I think the number that we had in venture capital was 40 exits a year, IPOs a year for the last 4 years on average. That's tiny if there's 1,500 unicorns, right? So I don't have the numbers on private equity right now. I'll probably get them in a minute of how many IPO-backed, private equity-backed IPOs there's been, but I don't think it's been a lot.
So can I comment on that, Marty?
Yes, please.
So
Sorry, there's been an average of 25 PE-backed IPOs the last 4 years.
right. So I think we need to be careful with that because not all exits are done via IPO.
There's no doubt about it, but the IPO typically has a 3x on an exit versus acquisition.
Right. But what I think, so let me just, so two things. VCPE, very different. Risk profile, very different. Expectations, very different. So I'll say that we stay away from VC personally, just because of the risk profile. It doesn't suit the family. On the PE side, if you look at most PE firms, return expectations have been more conservative, so they brought them down. But I don't see the time horizon lengthening. I still see the exit average around 7 to 9 years. Yes, maybe they're not doing IPO and they're looking at other methods, because at the end of the day, IRR is the focus, right? And to get people to come back to them, they focus on the IRR. So they're showing, we're looking for 17 to 20% returns. Fine. Which 17 to 20% returns is not bad in the grand scheme of things over a period of 5 or 7 years, right? Because that hopefully is better than the S&P. So the comparable now is, okay, what's your expectation on the S&P? And Goldman's came out with a study a couple of months ago where they think the S&P is going to outperform private equity, and therefore family offices will be more liquid markets than illiquid markets.
I have one comment on that. So my comment on, you really can't do an apples to apples comparison of S&P versus private investments.
Oh, I agree.
Because there is a liquidity premium
I agree.
on private investments that because they hold the money for longer, you can't
can't get out.
get less utilization of your capital and the ability to take advantage of situations. So academia says that private equity should realize a 4% greater IRR than the standard market, than the public equities, to rationalize doing a private equity investment.
Marty, I think 400 basis points is too conservative. I would be more closer to 7. But yes, I totally agree with everything you just said. I'm not arguing those facts. It was more that Goldman's came out with a study saying people are going more to liquid than illiquid, which I don't totally agree with.
Well, in directs, I think directs are family offices are many families are positioning themselves more for directs than funds.
Possibly that's not our experience. I mean, a number of the families who've done directs have gone more skew if than good, to be honest. So we're sticking to the funds route, but again, you know, I don't see the timeline lengthening out. And the reason, by the way, for the increase in secondaries is not that I would say families and private wealth is running for the door. It's that more of the institutional money over allocated and then found themselves with a liquidity crunch. And so they're funding these secondaries. Now, that doesn't mean I'm going to go and run and invest in a secondary to get someone sloppy seconds, because the discounts that you're getting the secondaries on is not that compelling. It's 10% discount to NAV. That to me, I don't get out of bed for. But I don't also think that family offices are just there to shore up the liquidity that's necessary for investments. Again, going for sloppy seconds, that's definitely not happening. I think we're a lot more selective than people realize.
Sammy, just to cut back into what you're saying,
Yes, sir.
as I'm not just saying that families are just as institutional capital, but they're intuitional capital, and that there's better stuff out there, as you just said.
Mhm.
Right. And people who are experienced in the secondaries market knows that secondaries had a 50-point spread in 2010. You had amazing secondaries. So it's not even that it's sloppy second. It's just like the last stuff, out of the pot of coffee, right? I mean, you've got the grains in there and the beans, right? So
Right. We're agreeing 100%.
No. I'm just adding.
Yeah.
I'm sorry, Igor. So the question is, duration, quality of the private equity offering, and I think we brought it up in the last panel that maybe there's just too much capital out there chasing deals.
Well, on the topic of too much capital chasing deals, that's been said by many top managers about too many small middle market PE firms out there chasing too few deals, particularly in this environment. It's hard for me to cast a vote here just on a macro scale. I guess we'll have to see if we will have some positive sort of macro environment and M&A will rebound. But on the holding period, like I said in my previous comment, the holding period is definitely extending because the M&A market is just not there. And firms prefer to hold rather than enter a process in the uncertain market. And in terms of quality, there's definitely a whole new sort of higher bar of quality that investors demand versus, say, pre-COVID or, once we first recovered from the initial shock when things were going well. So I think new investments are high quality. They're more conservatively underwritten. And I think old investments will have to be held longer because even if things go to the old sort of pace, there's just a huge backlog of deals that people cannot exit. And there's this other situation where mid-level professionals and sort of junior partners are borrowing 50% to invest in side-by-sides, which is not required, but kind of required to keep your career going. because if you're not going to invest any of your bonuses into side-by-side vehicles, it will be hard. So you have a situation where there are uncertain mark-to-markets and people have invested a lot of their personal wealth with leverage into this deal. So that's another sort of point of pressure.
Another question I have is that so you have these deals and some of them are 7 to 10 to 12 years old. They've gotten to secondaries or they've gotten into continuation fund or whatever. Many of them are service oriented. Aren't those service oriented firms being now challenged by AI oriented firms? Like, for example, you've got an AI challenger for everything customer service, like agentic AI, right? Customer service, technology services, right? All these different topics that now you're just going to have an AI agent delivering this delivery, and that should change your whole valuation of this old stuff in your portfolio. I think I could be wrong, but your perspective?
Well, I have a somewhat more optimistic view here, maybe than some, and that is that commercial relationships are more important, and so these folks are going to be the first to capitalize on AI because they already have the customers. So their workflows would improve with relying on AI. I mean, who's better positioned to benefit from AI than people who are already providing the service, understand customer needs, understand the points of inefficiency in the human model. So I think the competition from AI maybe would be offset by higher efficiency of incumbents deploying AI. So I have a friend who is a M&A guy at a top firm, portfolio company that is service oriented and sort of software, light digital engineering oriented. These are the type of areas that you would think would be prone to failure in the AI world, but they're firing on all cylinders and buying little companies that are traditionally staffed with computer programmers developing bespoke solutions to clients.
Sammy, do you have any thoughts on that about whether new entrants might reduce the value of old challengers?
Yeah, so I think the jury's out. I think it's too early to tell because from one standpoint, I think everyone has to wake up and smell the coffee and say, AI is here to stay. And to a certain degree, you have to either get with it or you're going to be out of it. It's kind of like looking at IBM and Apple back in the day, right? IBM kind of sat on their laurels and now nobody has an IBM computer. So AI is kind of, it's here to stay. I don't know if the old people will just phase out or they're going to upgrade and integrate. The fact that they have clients doesn't mean that the clients will stay if they get better service. If that's the mentality, then they're done for, and I would want to be out of their businesses. So I mean, that's my kind of point of view, but I think it's too early to tell. It's too early to tell what impact it will have on those companies. It's really how do they act or react.
Interesting. So, what other hidden exposures do you see in the private credit funds, and maybe that aren't obvious until the borrower?
I just want to add something on AI because I think what Sammy's saying is right. I think AI is definitely here to stay, but what I think everyone needs to remember about AI is what happened to fiber in the early 90s and what also happened to a lot of the early NASDAQ entrants. We had Kevin Ryan here a few months ago, who was the CEO of DoubleClick. I worked at an investment bank. We took DoubleClick public at a valuation of, I don't remember the exact number, but call it $1 billion. DoubleClick probably got down to a market cap of 250 million. Ultimately, it got sold to Google. Today, if you broke DoubleClick out of Google, the valuation would be 100 billion. So I think you're going to very likely see a revaluation of these AI companies before we sort out who the winners and losers are and the ones that are really going to lead the sector going forward.
Any thoughts on that?
I'm going to add to that. If you want to go back, let's look at the .com bubble. right? Anything with the name .com, people threw money at without having any understanding of was it internet or otherwise. And one of the major banks had an ETF of .coms, and half the companies had nothing to do with the internet. And I think we're doing the same thing with AI. Everyone's throwing money at anything that looks, smells, or seems to be AI related, and it's inflating valuations. I totally agree with that last comment. Fantastic. Thank you so much. Again, we need to be cautious. It's like anything, do your due diligence. There's going to be the winners and losers, just like in private equity. You got to be really careful where you put your money, especially when you're locking it up. But any investment, there should be a modicum of due diligence, and in liquid markets, one can be nimble. Private equity, you can't. So you've got to be very cautious on how you allocate. And Shelley, coming back to the question on like what was it,
In dangers. Yeah.
hidden dangers. I'm not going to speak about private credit. I mean, private credit. Look, you have to hope that the team managing the private credit is doing their due diligence at looking at all the clauses in the credit documents and then the liquidity of the company. And then things that can change. So like the tariffs, does that have an impact, a material impact on the company and their ability to repay? Okay, what's your ability to renegotiate? What's the chance of you losing capital? What's the percentage of your deals that's going to lose capital? And that we're relying on the manager, because once you've subscribed to that, if you're locked in for whatever it is, 3-5 years, you're locked in. So you, the investor, doesn't have much say at the table and doesn't have the flexibility to get out, not even through a secondaries. So I think, again, with any illiquid investment, you have to make sure you've done your due diligence and you've asked those hard questions. And if you're not satisfied with the answers, if they don't answer them in a very thorough manner and show you their risk systems, the way that they really go into the numbers and understand the risks and their exit strategies for when things go sideways, then don't put your money there.
Anything else to add there?
Well, this is not an AI panel, but it seems like every panel here is turning a little bit into that. I will say that I attended like a private conference hosted by a PE firm, and there was an AI panel there, and it lasted for 2 hours. It was kind of boring. And what I understood is that PE has limited ways it can play AI, and a lot of times private equity wants to be on the sidelines of a hot area because that reduces risk of overpaying a little bit. But here, smart folks on the credit panel just an hour ago explained how investing in data centers brings its own risks. And so I think everyone is very focused on it, but in many ways, it's harder to play than, say, fiber or SaaS or .com. And I think that just the desire to be somehow connected to that ecosystem is going to lead to tears because people will overpay.
Yeah, so you touched a little bit there on risk. And I'm curious if either of you think there are specific regions or sectors where credit risk is. Oh, do you have a question? Yeah.
Not a question, but a comment. In every situation, no matter what the investment is, you always want to try to mitigate the beta and secure the alpha somehow. Otherwise, it's a crapshoot. And AI is no
AI is beta
AI
right
is no
now.
different than any of the other brilliant things that have come along that people have lost their shirts on in the past. Again, you have to understand the beta. And once you understand the beta, how do you mitigate that beta? By alternative methods to get the alpha. Otherwise, you're going to lose your shirt.
Any thoughts on that? Sammy? No.
No.
So
Go ahead.
back to my question, any specific regions or sectors where credit risk is, rising more quickly than the market is pricing in, such as Brazil or China, commercial property linked real estate infrastructure?
We're not focused on credit risk per se, because that would be you're taking a very big stake in a specific sector or company, we're looking to remain diversified. We try again, if it's about controlling the beta and squeezing out the alpha, it's about diversification and understanding the risks of where you're investing. This year, and someone made the comment, I think, or maybe I'm mixing things up. I was at a board meeting this morning. We have an investment portfolio. I sit on a board of a hospital, and their portfolio underperformed because they didn't have exposure to Europe. Europe. This is the first year in a long time Europe outperforms the S&P, right? So having exposures to foreign markets sometimes can go in or against your favor. For the family, we put a good portion in Europe, and it played in our favor. So again, credit risks per se not focused on, because that's not what we're playing. But when we look at, we're more equity type investors. So we don't, we're much less in the fixed income world and the credit world, even through hedge funds and private equity. So we're looking for alpha. We're looking to outperform inflation by 500 to 700 basis points. That's our target return. And again, it's looking for those interesting niche plays. I think that
I have a question about Europe,
go on.
Sammy. So in the United States, you know, there's what they call the boomers, and a lot of them are retiring and they're selling their businesses. Is that happening in Europe as well? And are there opportunities in that? Are there people doing roll-ups or things like that?
So Europe, I'm going to try and be as politically correct as I can. Europe has so many problems at the moment. Okay. You've got the aging population as an issue. A lot of family businesses that are going to probably go and move more to be bought out. There's a lot of consolidation that needs to happen in so many different sectors where Europeans keep kicking the can down the road. One of the reasons I left Europe, to be honest. There is a big issue with I suppose boomers. Again, Europe has an aging population. The way they've tried to combat that has been through immigration, and that's led to a whole load of other issues. And you look at the UK, right, where I grew up, and I'll be back there. I'm flying out tonight. They have some major issues going on because of immigration. It brings, you know, positives and negatives, and it's more a cultural issue that they're struggling with. So, you know, it's a very different ballpark. I think we make a mistake as investors. We look at European stocks and US stocks, but end of the day, if you were to look through the balance sheets of all those companies, they're all global. They're no different than the US companies. They're all global. And yet European companies over the last, I'd say, decade or so are punished just because they're listed in Europe. They have underperformed the US, and yet they've got the same exposures, the same geographic exposures as US companies do. So, you know, you look at Nestle as an example, or, you know, what's it called? Glaxo is another one. They're global companies. Mercedes, no different than Ford. Maybe they've got more external exposure. So that's where I think there's interesting opportunities, because I do believe there is a misunderstanding of those markets and there is opportunity, but you can't go against the trend. This year has been the first year where the trend has changed.
But Europe may have global companies, but in many cases, their biggest market is the United States. So they're being tariffed. One. Two, they have uncombined from Russia. So their cost of manufacturing has escalated dramatically. So I mean, I think that's just a fundamental thing more so than prejudice.
So you made a very interesting point. They need to decouple from Russia, like big time. Like with all that went on with Ukraine, not enough. Not enough. They really haven't. They still are very dependent on their gas. I mean, really dependent, which is crazy going into this winter. They need to do more. They haven't spent enough on defense. They've been very weak on that. Where Trump has made the look, I'm not advocating for Trump, but he's been right on what his condemnations of NATO. By the way, as a private equity investor, as an equity investor, defense in Europe is going to get a lot of money coming their way from the governments. That's a great opportunity set, because that is going to change, right? That is happening.
So we had a European speaker this morning, and he thinks that there's going to be a lot of unrest in Europe due to inflationary policy, including deficit spending on military.
Again, the European debt to GDP ratios have been horrible for decades, right? It's not new. Unfortunately, the US is not far behind anymore, which is problematic and concerning. But again, they seem to get through it. I don't know how, but I I don't know how much it's going to be inflationary. Um, that's not my point of expertise, and I'm not going to get into that. But there are trends that make Europe interesting. I'm not advocating, by the way, for people to go and invest in Europe. That's not what I'm saying. What I'm saying is there's been this kind of similar market that has majorly underperformed, and this is the first year where there's been a little bit of catch up. Okay. And there are areas of interest or opportunity as an investor. Now, does that
Yeah, Sammy, I think the conclusion yesterday was that people are going to invest in Europe because a lot of people want to pull their money out of the United States. So I have no problems with
Oh no,
thinking.
yeah, I wouldn't say because they want their money. I think that if that's what they're doing, then they've got to, excuse my
Okay.
language, ass backwards. So
I think Andy Fish has a question over here. Andy?
Sammy, rolling back before geopolitics and fact of this bank recap trades in Europe from 2009. So anyway, back to companies and valuations. Just let's drill down to that. I'm going to give you an analogy so you can answer the European version. So I was heavily invested in Japan for years, good companies, and supposedly undervalued, meaning you're buying equity. Here's the profitability of the company and all that kind of stuff, fundamentals. Okay. So, and it was true. And the problem is it's still true today, all these years later. So that valuation gap never closed. So how do you view your specific companies that attract you in Europe, not all the whole thing? How do you view that?
I think Japan and Europe are very, very different. Okay, in that Japan has major.
I said it's an analogy, Sam. It's an analogy. You don't have to address Japan.
No, I understand. I'm trying to address it and show you the differences and why I think it's different. So the reason I think that I understand the analogy. I think the difference in Europe is, again, Japan is very close to external factors. They're very internal. They don't like foreigners. Most of them still don't speak English. Europe has adapted to try and be more of an international player and work with the world. So I think that's a very big difference. Again, Europe is not, or it's come out of that deflationary period they had for a short period of time, where interest rates in Germany were negative. Again, I think Europe, in terms of they've done some structural changes since 07, which are very important, that were lacking. I lived in Italy. You couldn't fire people. I worked in Italy for 10 years. You couldn't fire people. They changed that. In Spain, wages were linked to inflation. They've changed that. They've changed a lot of things that have made them more competitive and more America-like. I don't think they're there, but they're better than they were. They still have some structural issues they have to work through. I think Japan has ignored the structural issues. I think European companies are lacking. They've been a service area, not a manufacturing area.
Could you address the valuation gap and what might close that? Or is that what it was, or was that your answer? I'm not sure.
The valuation gap, again, it's people feel, look, the US market is the biggest market in the world to invest in. It's the most liquid market. It's the most transparent market. There's more regulation. People can understand it better. I think that's the valuation gap. I think it's all there. It's that people feel more comfortable investing in the US than they do in Europe. But other than that, I can't explain to you the valuation gap.
And is that, you think that's going to change or it's not going to change?
Really can't tell you.
No idea. Okay, fine.
I
Can't
think
tell you.
I think if the cash flows are there and the fundamentals are there, and you could argue that market beta is one, the answer is these markets just have high market risk premium. If you think of valuation and a kind of traditional kind of theoretical finance sense, and market risk premium is higher because of these issues that Sammy just alluded to, and many other issues that we know these markets have, like labor inefficiencies, non-performing loans that have not been resolved, and various other issues. It just, they have higher cost of capital. They have to work harder to achieve the same results.
I think we've got another question here in the audience.
Actually,
Comment.
more of a comment. My name is Claudio, and I'll be participating on the panel here later on. But I'd like to echo most of what Sammy has said. But fundamentally, when you look at the United States and the rest of the world, for everybody's reference, I'm originally from Portugal, went to school in Germany, so I know the European market very well. We transact internationally as well. On the middle market side and have transacted there before. I think fundamentally the valuation gap that many are asserting that is closing at the moment has to do, I think, with exactly what Sammy has said. There's been a lot of structural changes that the countries have undertaken, and that has positioned some of these nations to return to growth. Because the reality of it is, investment will typically flow where you have growth prospects and aspirations. And for many, many years, those have really lacked in Japan, as you kind of indicated, and certainly in Europe. And for the first time, arguably, you're going to have to kind of assert funding growth via debt. Is that going to be, mid to long term, the right way to do it? I think time will tell. But fundamentally, growth has been stagnant. And I think, Marty, you made a comment earlier. Germany is, for all practical purposes, an export nation. Their growth for many, many decades could basically relate to how they did exporting. And arguably, you can say that about certain Asian nations as well. So fundamentally, I think the valuation gaps, certainly in the public markets, have been closing. But I believe it has really more to do with growth prospects for a lot of these regions that for many years haven't been produced.
Yeah, excellent. So any closing comments?
I actually have one more comment on that.
Yeah.
So the comment on decoupling from Russia for Europe, I think, is a big problem for Germany, since they get all of their energy from Russia. And then politically, the substitution is natural gas from the United States, which is more expensive. But I don't know if the United States wants to export its energy to Europe for political reasons, right? So, right, I mean, eliminating Russia from the market only makes things more expensive for Americans. And to me, that's just bad policy. Because energy prices will go up if we have to feed Europe.
So I think you'd only export what you don't require. You're not going to export stuff you can't afford to export. So if it's an additional area of income, like I'm all for it. If it's at the detriment of your own, then I'm not for it. I think the idea of building a pipeline to supply Europe with gas was not to impact Americans negatively, but another source of income. And if you have the capacity to be able to create more gas and export and decouple from Russia. Look, if we get into the whole geopolitical thing, it's kind of complicated, because if we start alienating Russia and China and others, they're creating their own market to compete with us, and it becomes more dangerous, right? There's no right answer here, but I'm
just dovetailing into Claudio's comment, which is that there are lots of dependencies with Germany, which has historically been the economic powerhouse of Europe.
Right.
And France is really a sick puppy right now, right?
Well, so France has been a sick puppy since the 90s. It never wasn't. France is very, very arrogant about its situation, but has never been in a great position. Germany was the powerhouse, but people also forget Portugal, Spain, Italy, Poland have also been great drivers of growth in Europe, and very kind of forgotten. Germany was always kind of the poster boy. Be it with Helmut Kohl or Merkel, they were the poster boy. I think things have changed. And now that doesn't mean that Europe isn't interesting. Europe is interesting, But one has to realize Europe is an amalgam of foreign countries trying to work together under a non-combined language, and the only combined language is English. And I think, you know, there's still in my mind, a baby nation as the EU, right? They're still trying to figure out their way. But I think not to be underestimated, because we're going to have these regions of power, be it China, America, and Europe. So I think, you know, the big difference in the areas is that Europe has very good developed companies with corporate governance and rules and rule of law that works, that, you know, should give one comfort in investing. So yeah, again, I shouldn't be written off. I'm not saying it should be all of your portfolio, but a modicum of investments in Europe, I think, is healthy. We have about probably an hour.
Can we get a closing statement from Igor?
Yeah. Igor, you want to give some final thoughts here, and then we're going to wrap it up.
Thank you. My experience is predominantly domestic, but I've dealt with some international situations, and I will say, relative to Japan, well, I don't want to say they deserve a discount to market, but if you work with large Japanese corporates on M&A and you see their processes and decision making and how they manage mid-level managers, the inefficiency is shocking, and the logic of their decision making sometimes doesn't make a whole lot of sense. So I will say they have significant opportunity to improve, and it will ultimately enhance productivity and hopefully flow into their valuations.
Great, fantastic, great job, guys. Thanks so much.
Thank you.